I think they're underestimating the ability of the Fed to provide its put. I think the summer months are going to be bad for equity markets. I think sometime early next year, you play the upcoming cycle, which is not a long cycle, 18, 24 months. So add to your gold holdings, but physical gold, not ETFs.
Gold's price appreciated more than 10% in 2017, 2019, 2020, 2023, 2024, and in the first quarter of 2025. Most of these years were strong on the equity side, but the first quarter of 2025 is signaling a divergence. Equities were down, and gold was up more than 19%, but the markets have been trying to digest an ever-changing tariff backdrop from the Trump administration during this time. The value of gold has increased faster than both stocks and bonds since the start of 2024, as growing uncertainty has led investors to seek safe havens. Economist and strategist SimonHunt predicts a rough summer for equities, followed by a short market cycle that is expected to begin early next year. In preparation, he advises increasing physical gold holdings rather than ETFs. While reflecting on the market, SimonHunt expects base metals to drop soon due to a G7 recession, but sees a sharp rebound in the future. He recommends focusing on short-term commodity cycles over long-term bets. Based on fundamentals, SimonHunt believes gold will benefit most if the U.S. fails to stop BRICS. He also speculates the U.S. may adopt a two-tier dollar system, one domestic and gold-backed, the other international and floating. The 2025 summit marks a turning point for BRICS. Investors should focus on members with legal stability, India, Brazil, and neutral geopolitics, China's BRI, Brazil's green push, while avoiding overexposure to Russia's sanctioned economy. Sectors such as tech, infrastructure, and energy, backed by ETFs and bonds, present compelling opportunities to capitalize on the BRICS' evolving role in a multipolar world. Looking at the current trends, Hunt likens the AI boom to the dot-com bubble, cautioning against inflated Western valuations. Concurrently, Hunt states that China, Russia, and Iran are aligning to resist U.S. efforts to isolate them individually. Before we dive into SimonHunt's sharp insights from his latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
First of all, the base metals always track macro developments. So if we're right that we see G7 recession until the early months of next year, then you'll see sharp falls in the base metal complex. But then from the early months of next year until 2027, early 2028, you'll see a doubling in the price for many of the reasons I've already outlined. But then you don't want to be the last guy on the dance floor, because that's when the big crash comes. The bottom line is you've got to play these short-term cycles. Don't look for long-term investment. I think the primary beneficiary is gold. I think that if America fails to demolish BRICS, gold will be the foundation for their new currency. At the moment, the Shanghai Gold Exchange is in the process of building gold vaults in BRICS member countries. Actually, I think the first one that is being built for other reasons is in Saudi Arabia. So the game plan is obvious that a country that is running a trade surplus with another one, the balance collateral is held in gold in the Shanghai Gold Exchange in that country. It's basically what goes on with the trade between China and Russia. As I understand it, Russia holds a very large trade surplus that's collateralized with an equivalent amount of gold held in China's central bank gold vault. The difference.
So the world returns to a gold standard. The BRICS world returns to some sort of gold standard.
Well, that's what BRICS is going to do. Whether America and the G7 countries follow suit is a different question. I wrote a paper about a decade ago based on something that a well-connected friend of mine, who unfortunately has passed away, tipped me off about, where he said, Simon, think about America having $2, one for domestic consumption, which will be backed by the gold that the Treasury holds, and the other will be the international dollar, which will have to find its own level. Now, whether that's part of today's game plan, I have no idea. But look, makes some sense. I think they're underestimating the ability of the Fed to provide its put. I think the summer months are going to be bad for equity markets. I think sometime early next year, you play the upcoming cycle, which is not a long cycle, 18, 24 months at most. So add to your gold holdings, but physical gold, not ETFs. The experts that I listen to, who are normally right, think that what we're seeing with A1 now is a repetition of prior dot-com bubbles. There is obviously going to be a large usage of A1. It's the valuations that are questionable, whereas China looks at it a different way. They've not spent the billions of dollars. They have an A1 model that's available to everybody. And what Washington fears, two things. First, China has the world's most efficient and competitive manufacturing supply chain. You can get anything within a radius of 150 miles. It's that concentrated. But the big concern in Washington and elsewhere is that China has been using robotics, automation, powered by A1 to take their manufacturing system a further stage towards being more competitive by putting A1 robotics, etc., onto their existing highly competitive system. There are now factories powered only by humanoids, no humans in the system, with one plant, I was told, producing a smartphone every minute, humanoids only. So that's the first big worry for Washington. The second worry, so I hear, is that China is surpassing America on the development of new weapon systems. I think China, Russia, Iran. You got three guys who are going to stand firm instead of what's believed to be Washington's policy, which is to hit each one in turn. Now, China, Russia, and Iran say we will have more success if we stand as three against one. That's why the attack on Iran, the outcome of that is so important. It's not just regional, it's global. Because if Iran is defeated, then China and Russia know they're next.
In his assessment, SimonHunt predicts that G7 central banks will eventually flood markets with liquidity, triggering a new stagflation cycle. Hunt forecasts a 25% drop in equities over the summer, followed by a short-term rally into 2026. But by 2027 and 2028, he expects a major crash driven by double-digit inflation and surging bond yields. The 2025 stock market crash refers to a sharp and unexpected decline in global equity markets that began in early April and continued into June. Major indices, including the Dow Jones, S&P 500, Sensex, and Nifty 50, experienced steep losses within a few trading sessions. For investors, this crash served as a wake-up call about the volatility and interconnected nature of the global financial system. According to Citi strategists, the S&P 500 index of U.S. companies has historically fallen by more than 5% on average 3 times a year since the 1930s, with larger drops occurring less frequently. So, while it's not very fun for investors, it's certainly not unusual. Furthermore, Hunt underscores inflation is cyclical and likely to rise again with wages following suit. A key trigger could be Middle East tensions, especially if Iran blocks the Strait of Hormuz, disrupting oil flows. He warns that a U.S. strike on Iran would almost certainly provoke retaliation and spike global inflation. Let's get back to the interview.
What did they do on the onslaught of COVID?
Spend.
At some stage, they will flood the system, not just in America, but globally, or let me be more precise, in G7 countries. Central banks and governments will flood the system with liquidity. And what does that do? We know that's part of the new inflation spiral.
So
And as
their
I said
policy
earlier,
response will
what
make
does
it
that
worse.
mean? It is stagflation. It will be stagflation. What does that mean? It means that there comes a point when inflation is rising higher than growth. Growth will be driven by inflation, by households. Instead of spending X dollars a month, it'll be X plus Y dollars a month on their necessities, which means then that the non-essential spending will be cut back. And what does it mean for corporates? Long-term interest rates rise. They see inflation rising sharply. They buy more goods, whether it be components, products, anything. Instead of holding, say, 2 weeks of stocks, it'll be 4 or 6 weeks. And in fact, there's a much bigger development that is probably only just starting, and that is with supply chains, global supply chains being disrupted and being uncertain. Companies will be ditching just in time that optimizes capital in favor of holding additional stocks of everything in order to have their security for the supply chains. What is that going to do to inflation? And then if we're right and we do get rising energy prices, what does that do to shipping costs? Equities, you're going to have very short-term sharp rallies followed by protracted falls. I mean, to quote one example, I think we are at the moment now at a very critical inflection point, taking the S&P as an example, and that will be followed by at least a 25% fall over the summer months. Then you will have the Fed starts and all the central banks, because this will be partly due to geopolitical pressure points intensifying. So that's when, by the end of this year, central banks and governments will be starting to flood the system. So on our work, we will see markets bottoming by the early months of next year. And then you probably, over the next 18 months, you see a doubling in prices. Then you get the big fall, because 27, 28, you've got double-digit inflation, double-digit yields on long-term bonds. Inflation goes in cycles. If you go back to the 1970s CPI inflation pattern, it came up like that, it came down and went up. And we're in that same process at the moment. So what are wages going to do? The wages will probably have to go up higher as inflation rises. So it's a cycle. We're probably in the bottom of the cycle now. How quickly inflation rises may well be determined by what happens in the Middle East.
How so? Oil?
Oil. Iran has yet to make the decision on whether or not to close the straits. They made these preparations at least 2 years ago. The seabed has been mined with explosives, which can be triggered by a switch. And they have a couple of tankers, which they will sink in the narrow part of the channel. And I saw on a video a dress rehearsal that was done a few days ago. So before they make the decision on whether or not to shut the straits down, they have announced that any vessel passing through the straits will have to have permission to pass by the Iranian government. And I was just heard today that there are tankers lined up waiting to go through. The other thing you have to consider is probably now insurance companies won't provide insurance for vessels going through. So that's the first part. I mean, if America attacks again, which I think they will, then I'm pretty sure that Iran's retaliation.
During the 1968 to 1982 period, gold outperformed broad equities by approximately 25 times, highlighting its effectiveness during sustained inflationary environments. The latest gold forecast outlook suggests similar conditions may be developing in today's markets. This comparison helps investors understand the potential role of gold in a diversified portfolio. How might investors best position themselves between 2025's volatility and 2027's potential crash? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.